Okay, today we're going to talk a little bit about balance of payments. Let's go. First, let's get a good definition. The nation's balance of payments records all the transactions that take place between its residents and the residents of the foreign nation. And we're going to be looking at it from the perspective of the United States today. Right? Well, what does that include? That includes merchandise exports and imports. It includes tourist spending. It includes purchases of sales and shipping and insurance services. Also includes interest and dividend payments received, and purchases and sales of financial or real estate assets, and so on. So we take all of that into consideration, right? And when we do, we get a chart that looks like this, or a schedule that looks like this. And basically what I'd like you to do is pause it right here and get this schedule down. So go ahead and pause it. All right, so you've got this schedule down. And you've got the goods and exports at 684. Okay, you got a balance of trade and merchandise. This is goods and services. Merchandise here is goods and services at the current account includes, we've got the balance of trade and merchandise. We talked about that, goods and, or just goods. And then we've got services of plus 81 billion. Okay, and then the net investment income is the difference between dividend going out and the dividend coming into the United States. And that is 18 billion. And then we have net transfers that come in at negative 48 billion. So, and this includes like foreign aid. So if the United States were to give, $1 billion to Japan or some type of other country that's experiencing a natural disaster, that would show up here. And it's a good idea to have these definitions down so you kind of, as you look at that capital balance sheet, you kind of have a good idea as to what exactly is going on. When we take a look at the capital account, that's going to talk about real investments, which talks more about real estates and businesses, and financial investments, which deals specifically with stocks and bonds. Okay. The foreign purchases of the United States, the U.S. assets, would be a plus $760 billion. That means foreign money coming in and buying money or buying real estate or other businesses. That's a plus 760. But the U.S. and people in the U.S. also buy foreign dollars overseas, or foreign businesses overseas, and so the U.S. is going to lose $438 billion of dollars going overseas to buy those businesses. Okay, and this is where the official reserve count comes in. There's going to be that situation where it's not always going to equal zero. All right, and so what you've got here is the official reserve count representing the exchange of foreign exchange reserves to make sure that it always equals zero. And in this case, we've got $9 billion out. In other words, we have $9 billion in foreign currency that we need to get back. We need to get to dollars, essentially. So we're going to send $9 billion worth of euros out and get $9 billion because there's more European money here in the United States than there is American money. And so we're going to get $9 billion back because a lot of American money went overseas. Okay, so we need to get $9 billion back. So they'll go to the euro, they'll get $9 billion back in American money, and so now we got $9 billion. Does that make sense? If that doesn't make sense, go ahead and ask me in class tomorrow. Essentially, we're running negative. We've got more foreign money in the United States than we do American money, so we need to get the American money back. All right, balance of payments. A deficit occurs when the sum of the balance of the capital account is negative, and a surplus occurs when it is positive. Okay, persistent deficit balance of payments are trouble since reserves are being depleted in time, and that is not good because we're always going to be trying to dip in and try to get our money back, and we're going to be using the foreign money to get back. And some simple policies to correct the problem are essentially currency depreciation, which we'll talk a little bit about later this week, trade barriers, reduction of budget deficits, and lower interest rates, along with easy money by the Fed and other, like the banks and the federal government too. So that's really about it. That's balance of payments in a nutshell. We're going to work on some sample balance of payment problems when you get to class tomorrow. That is all.